Hello and welcome to another episode of Enter the Boardroom with Nurole, the business-oriented podcast that brings the boardroom to you. I'm your host, Oliver Cummings, CEO of Nurole, the board search specialist and market leader, bringing science to the art of board hiring. Today, I'm delighted to be joined by Mike Reid, founder and senior partner at Frog Capital, a scale-up investment firm which backs European software organizations making a positive contribution to society. Prior to founding Frog, Mike was a director at 3i, where he specialized in technology investments. Mike, a huge welcome and thank you for joining us today.
Delighted to be here, Ollie.
I'd love to talk about working with scale-up chairs. And I guess the starting point there is, what in your mind is the role of a chair in a scale-up? Why do people need a chair?
Right, good place to start. First off, what is a scale-up? Everybody has a slightly different definition. Our definition would be one element is size of company. So typically 50, 60 employees, shifting with a vision in fast growing scale-ups to exceed sort of 200, 300 employees over time. So a real sort of ambition around the business. Other elements can be internationalization in terms of increasing complexity of the business. And most importantly, a real change in the dynamics of the going from a kind of founder-led, very integrated and tight, probably slightly micromanaged startup phase through to that journey as a CEO, founders shifting sort of roles from becoming kind of professional CEOs of the business and therefore into that role of becoming sort of managers and coaches of managers, managing other people, which is a somewhat terrifying journey. In parallel, probably fundraising from other external new equity investors, maybe debt investors. So the stakeholder landscape is changing dramatically. The board of a business is becoming formed in this sort of teenage adult analogy that the company is growing up to become an adult in itself. And therefore, the sort of brain of that adult as the board needs to be kind of thought about. And then as you start getting into the reality of that, then any effective committee normally, certainly in our view, works more effectively with the chair. And then, of course, the role as the CEO can be assisted by effective coaching, mentoring, again, by a really good chair. And then, of course, with increasing stakeholders around, as we talked about in terms of equity, debt, plus others, again, a really good chair can provide great coordination and cover support an up-and-coming CEO.
Got it. Really helpful. So a lot of founders or CEOs, if you prefer, for scale-ups that I talk to, really struggle to get value out of their chair. And a lot of them will say that they feel the chair is riding the wave rather than helping them drive the entity on. You've put together a really interesting framework for how to think about the role of the chair for scale-ups. You talk me through that. Identify 5 core elements. And I think one of the first of those is, where do they spend their time focused in terms of strategic time horizons? Talk me through how you have those discussions.
Yeah, so you're right. It's a real shame to hear the stories when people feel frustration about their chairs, because ultimately they've got to that place clearly in the wrong way. Either the chair has been forced upon them, or they weren't fully sort of informed in what a chair was when they went and selected one. So yeah, I really empathize with that frustration. And it's kind of a shame because it undermines the thesis, because the conclusion is not, what's the point of a chair then? The conclusion there was, you got the wrong chair. So one of the reasons we have defined our chairing framework, the toolkit for chairing, is exactly that, to support both the beginning of the process, to start a kind of more informed debate around what's a chair for, what my expectations are, etc., and who's the right fit for the business. Also facilitating that dialogue with other stakeholders. So you may have an enthusiastic investor saying, right, I've got this chair, Ollie, he's going to come in and really help you. And then you can use a framework to say, well, okay, let's sit back and actually discuss it in a slightly more objective way, rather than say, he doesn't look like the right guy for me, kind of thing. And then equally through, and as importantly, every relationship with anybody in a fast-growing business, the dynamics are going to change. So using some kind of framework, whether it's this one or another one, is a useful way to have a communication tool to get different views going through the life of the company's trajectory.
So it's really interesting that you've chosen as the sort of the ends of that spectrum, 1 to 2 years at one end and 4 to 5 years at the other end. If I think about our own operating model where we have, everything from vision, mission down to our sort of 10-year, 5-year, 3-year, 1-year plan, and then the sort of quarterly rocks at a group level down through to the individual rocks or OKRs, whatever you want to call them. Why do you choose that part of the time frame to focus on for the strategic discussion?
Sure. And before answering that, maybe because listeners can't see the framework, it's available on the Frog Capital website, of course. But 5 criteria. One we're going to talk about now, which is sort of strategic time horizon. Where should the chairs focus beyond in terms of longer term, shorter term, etc. So I'll come back to that. Second one is all around sort of stakeholder focus. How much of the chair's time should be really on the team and the executive side versus other stakeholders and shareholders. There's a theme around governance and mentoring. So where's the balance? Where should the balance be for that? In scale up, Frog's not talking about the broader chairing. Fourth, around style. What kind of style is appropriate? Everybody has a different style. We're not saying one style is good or bad, but we've got some views around adaptive versus intentional. And then finally, development strategy. What are you trying to improve as a chair, and how much of your focus is trying to improve the management team, and also how much is trying to improve the board itself? So that's the broad framework. And then we've kind of given recommendations roughly. It's not an exact science around where we think in scale up should be. So if we take the first one around strategic time horizon, at one end of the scale, we've kind of got very short term, sort of 1 year, 2 year kind of time horizon. And at the other end, we landed on 4 to 5 because typically people don't think about sort of longer than that in scale up. And so there we're saying, really the balance should be sort of 60%, 40%, so slightly more to the kind of shorter term, but not forgetting. So there's 2 elements there. Sometimes you get chairs who are really good people, but they're maybe too far in advance. They're thinking that the priority of the board is to sort of debate out sort of 3, 4, 5 year vision, what's going on in the market, how are the big players working, what are we going to be doing? So our view is that's, yes, okay to do that sometimes, maybe once a year, etc. But ultimately, scale-ups are a little bit more tactical than that. But equally, many times you find people being forced to be too tactical, maybe because of resource constraints like cash, to say, well, okay, I would love to upgrade our head of sales or address our issues and bring on a CFO, etc. But there's no point even discussing it or acknowledging it because we can't afford it. Whereas our preference is to say, actually, together with your CEO and it's worthy to say, right, actually, if we did have the resources, we would make these changes. Maybe we can't for now, but even the discussion around that thinking is useful to whether it be your investor or even your CEO, not just to narrow too much down on the short term.
Got it. I think there's a lot of research out there on boards that will show that most boards, if you ask them, will say they don't spend enough time on that strategic stuff. And they spend too much time looking out the back window rather than looking forward through the front one. What is the proportion of time, because I don't think it's covered in that spectrum, that you're spending on this part of the spectrum more broadly? And how do you think about that?
Yeah. So a couple of examples I think are interesting. So where it feels right is where the board, and particularly the non-executives in the board, providing input and challenge to the executive, is when they're served up with really incisive KPIs around the running of the business, commentary on those KPIs around what's going well, what's not going well, a sort of on radical candor in terms of an honesty around stuff that's good, but also what are we dealing with the stuff that's not so good and how are we doing that? And therefore kind of thinking multiple quarters ahead as a non-exec. Okay, so what's happening? What are we going to be regretting we weren't talking about in this meeting in 3 quarters' time? Okay, so is it about we really need to make a personnel change in that role and putting more kind of drawing the CEO and team's views out of the sort of wood for the trees and say, look, you've got to make that change sooner rather than later. It could be over-reliance on certain customers. It may be chasing too many big deals that are too difficult to predict in sales cycle, etc. So more the sort of strategic elements of the tactical KPIs, if that makes sense. And where it doesn't feel right is spending, meaningful parts of the board meeting asking about updates on particular deals. Oh, Ollie, I remember we talked about, HSBC and Standard Life and the last couple of boards. How are we getting on with those? And who's leading those deals and what's the pricing? And too tactical. I would love to know about it. Maybe I can talk to you about that over a beer afterwards. But really, for the board meeting, our view is right that's gone operational, and that's not really helpful for the management team.
Got it. One of my favorite pieces actually out of McKinsey in the board space is around, how does a forward-looking board spend its time? And they've literally got the whole annual calendar mapped out across all the different areas that boards have to cover. And, I suppose you talk about the 60-40 here, but can you build out the bigger picture for me of that? How much time overall are you expecting your chairs to spend with organizations and your organizations with chairs? And then of that time, how much is spent on the strategic versus, the rest of the stuff? And then, so I get a better sense of 60-40. What does that actually translate into in actual days almost?
Yeah, that's a good question. So, basically with a company that's 50, 100, 200 people growing at 30 to 100% per annum, and you're non-exec chair of that business, if you're not talking to the CEO once a week, you're off the game. Now, that may be your Friday check-in call. How things going, Ollie? Anything we need to any sounding board stuff I need to do? I have some 2 issues, which are my stuck record issues. How are you getting on with those? Having that sort of oiling that connectivity to the CEO, etc. So I think that's some time, but that's kind of, you're kind of in your phone call, kind of Zoom call type territory. And then I think there's clearly sort of board meetings. Some people do quarterly. I find that too big a gap personally. Monthly is too much. So for me, sort of 6 to 8 weeks is a pretty good dynamic. And then I think from that cycle, you're thinking kind of, obviously chair being really clear around pre-board meeting around, okay, what's the point of this board meeting? Apart from telling everybody what's going on a bit, actually, what are our strategic elements? What are we trying to get out of the meeting? Doing a good job of absorbing that from the CEO and maybe the CFO as well, and having enough proximity to the broader team to kind of feel that the priority is right. And then equally on the board, non-exec board members, again, of understanding, okay, does that feel the right kind of topics to be doing? So that's a bit of time. And then obviously in the meeting, back to that expectation setting of how much is tactical, too much operational. There takes some boldness, because to me, it should be a good chair should be saying, right, we've got 2 hours, 2.5 hours of precious minutes. Every minute counts. I've got a lot of money on the clock here. How do I actually get my ROI out of every bit of that? And therefore, the agenda management is really critical. I think good chairing is getting through that reporting cycle, setting the expectation. You shouldn't be in the meeting without having fully read the pack. I love it when chairs just say, okay, Mike, what issues have you got from the reporting pack? And then typically investor directors say either they've read it and they really know what they're doing, and they've got 3 points to go address the 3 points. Great, we've done the investor pack, so let's get on to the strategic topics, which should be 50%, maybe more of the board meetings time in the 2.5 hour slot.
There's some really interesting research that says less than 25% of execs think all their board members have read their pack. What do you think that figure is for the scale-up community?
Actually, I think it's pretty well 100%. I do genuinely think when you're getting into you might have some people who've got 13, 14, 15 boards, typically early stage venture folks who are having to deal with that kind of model, that sort of struggle with that, particularly the companies that they know they've got a good chair in place, they've got maybe some scale up investor like Frog on board, and then I'm here for observing and just checking everything's okay. So actually that's fine. They've got a different role in the board meeting. But if you're going to be obviously a proactive member of the board, then the expectation, it has to be much firmer, and the chair has to set a really firm expectation of those are the behaviors that we require, because we're setting the stall, the benchmark for the rest of the business. We're demanding the business performs in a fantastic way, and we do as well.
Got it. Okay, so you're building that picture out for me, which is, every 2 months or 6 to 8 weeks, you've got, let's say, I guess, half a day's worth of meeting. You've got your hourly call on a weekly basis. What other time have you got beyond that you expect that chair to be putting in?
Yeah, I think there's the sort of less frequent, maybe annual sort of strat day kind of piece that we were talking around. I think strategy days, we've actually got a toolkit on our website, I think are done typically incredibly badly. I think all of the theories there, it's just people just don't do the theory. No matter how many times you say you should have an independent facilitator to a strategy day, guess what? No one really does it because it costs money and. But I think strat days basically done really badly unless you really, really think about them. They're almost a little bit tick box. So back to your McKinsey thing, it's easy to sit back and have a few copies and chew the fat on a market, but actually to get a really focused bit of output is really tough.
That's really interesting. Can I just pick you up on that one before you move on? The independent facilitator. So is that almost, how do you think about that? Is that the chair for the chair? If you're expecting that, why can the chair not do that facilitation role that they do at the board for the strat day? What is it that's different there?
We don't really we have sort of recommendations to what to think about. And there's no, so if you can have a strat day with a board, then typically particularly in scale up, your chair is probably one of the few truly independent, probably ex-operator industry experts you have with a non-exec. So asking that person to then also facilitate the meeting, you're just neutralizing the main character. Either they really do contribute to the meeting and forget to facilitate it, or they spend all their time facilitating and you don't get any input. So I don't think it's negative to saying, oh, suddenly I need a chair to chair the chair. Actually start thinking, well, what am I trying to get out of these individuals? What questions am I trying to answer? What research am I putting into the meeting? And what kind of questions are you trying to answer? Because I think ultimately the challenge with some of particularly investor-heavy boards is they're not typically industry experts. They're smart people. And so expectations have to be clear around what you can get out of that. And actually, I think there should be more onus on the executive team to do more of the strategic grunt work around you folks go and have a strategy day and then come back to us with your strategic findings. And then we'll assess the strategic findings. That's, to my mind, it's actually more pressure on the team because there's nothing more easy for a CEO to say, oh yeah, I can chew through an afternoon with some guys who don't really know my market very well, but that's a waste of time.
Okay, so going back then to that time allocation and where else you expect your chairs to be spending time.
So being informed about the market is one. Much easier, obviously, if they're already in the market, but if they're not, there's time around proactively kind of learning. And then the final piece, I guess, and I would say is probably one of the most important is, and I've seen some chairs just do it brilliantly, just unthreateningly moving through the business, walking the floors and having the trust of the CEO that they're not going to upset anybody, but having that kind of ability to disarm people, to check in, motivate, listen, kind of just pick up the nuances of what's going on in the business.
Can you bring that to life for me? What did they do that was brilliant?
Stress management, showing genuine appreciation for how hard people are working, empathizing with that, listening to it and bringing topics, not specific topics, but a sort of sense and recognition of, okay, we need to be thinking about things maybe in different ways. Or I've noticed more of a one piece. I think the second piece is harder edged, which is particularly in scale up where people are good people, but they're just out of their depth. And then when you whether you start to extrapolate, a year or 18 months of expansion down the line, then a challenge to the CEO, constructive one, to say, right, how are we going to deal with people who are now clearly at the limit of their capabilities? Because that's very stressful as a CEO to do people change and stuff like that. And sometimes, that needs coaching, nudging, pressure, or hard ass kind of, we've got to get on with it, Ollie. You're ducking this one, so just bite the bullet.
That resonates a lot, and particularly that point around the sort of the empathy. I always remember founders or operators telling me before, when I was in the investment world, you just can't appreciate what it's like. And I always thought, well, I get a good sense. I've worked pretty hard. I used to do, all-nighters the whole time, whatever it was. How much different could it be? But actually, having now walked in those shoes, I think I do have a very different sense. And it feels to me that it's quite difficult to imagine that if you haven't lived it. Are the people that you've got in mind, were they all operators? Do you think you need to have operated to really know that? Because I've also seen chairs who've gone, gosh, it's all really tough, isn't it? And they've tried to show that empathy, but it didn't land. And I don't think it was because it wasn't authentic. but they didn't have the credibility. Have you ever seen chairs who have been able to do that, who didn't have that operating experience themselves? Or do you think that is a sine qua non?
Yeah, I think it's much more difficult. So typically, I can't think of anybody, certainly of our chairs, who's not been a CEO, probably several companies. Not impossible. I think you typically find the characters who haven't been, and if they're good, they're just very good. They're just, they know what they haven't done, so they don't try and go there. But equally, sometimes you can have the opposite issue, which is too much empathy. And therefore, too much. And that's again back to the framework we're saying of our next criteria is yes, a lot of focus could be on the management team, but also a real understanding of how shareholders think. And actually back to, well, what did we pitch for the fundraise? What was the plan? How are we going to? So we had that duty to absolutely execute as brilliantly as possible. And empathy has a key part of that, but also taking tough calls fast is also part of that.
Tell me more about that. One of the most common things I hear from founder CEOs is when stuff is going wrong, it's that it's normally because the chair is not managing the board and that the CEO is having to step up and try to run the board as well as run the company, and those two worlds are fusing. Is that what you see from your side, and how do you think about discussing that with a chair of how they get that balance right between spending the time, with the management team versus the shareholders and board members?
Not trying to dodge the answer, but I actually kind of find that situation fairly rare. So number one, is the business on plan? Is it really performing well? So if it's not, then that's not the chair's fault. You might not be happy about the chair's role. You may pick the wrong chair and you might be frustrated about that. You're actually probably taking it out on the chair when you're actually just really frustrated with yourself. But you've got to get to the bottom of what's up with the business and the way you're leading the business to perform. If you are absolutely caning it and you've still got an issue with the chair, then of course, addressing that, and you've got a clear platform for addressing that and deciding on which stakeholders, if there are any around the table, like investors, etc., that you need to bring into the loop to kind of make a change. The performance of the business side of things is, and therefore the feeling around my chair is not helping me, not supporting you, is a frustrating one. But ultimately, it's back to the theme of sort of radical candor. It's okay. You've got to look in the mirror and say, right, this is just an important relationship. What is it about? I've got 50% of this relationship and that person's got 50%. How do I analyze why it's not working before I start concluding I'll just park it as a broken relationship and put up with it? Back to the framework, it's right. This is part of helping people depersonalize what is a tricky relationship sometimes, but start saying, okay, pretty well every successful business in the Anglo-Saxon world has a really effective chair CEO relationship. So that's our goal together. We're both aligned to that. And let's get down and use some kind of framework to eke out why I'm not feeling 100% about it and maybe why you're not feeling it as well.
Got it. And so on that spectrum, where in your experience do chairs tend to get it wrong? Do they tend to lean too much into the management team or too much into the shareholders?
Probably founders may find this odd, but they tend to, in our view, on balance, I would describe it slightly differently. To say it's not about do they favour or balance towards the management team. Our framework recommendation is absolutely the focus should be the executive team, the CEO, and all the stuff we talked about that. But reminding actually that the CEO and the CFO need support in making sure the chair understands what's going on with the shareholders. What's going on behind the scene? Where is there something, any sort of pressure building up that we're not realizing? Okay, maybe we've got a funding round coming up. The CEO the chair should be a really constructive part of eking some of those questions out, in between board meetings, understanding what's happening, particularly if you've had a change in investment director. Some of the best chairs, they have strong relationships with the managing partner of a fund, so they can put a call and say, okay, where are we on your map? Are we in or are we out? What are you going to be supported? And just massive relief to the CEOs. Okay, don't worry, Ollie, I've checked in. Yeah, we got to do X, Y, Z, but it's all cool. We're going to be fine. So you crack on with the week by week stuff.
That's one I've heard come up a few times, actually, where you've had a particular investor behaving in a certain way because they were doing a new fundraise and they needed to show an exit in their portfolio. And therefore, they started exhibiting some counterintuitive behavior, would be how I've heard certain CEOs describe it. What is the chair's role there? Because one response I've seen people take is to go to the investor and say, hey, your responsibility here as a director of the organization is to the organization, not to your shareholders. But at the same time, we live in the real world, and that investor is clearly under pressure to show an exit to help them raise the next fund. What's your kind of advice to a chair walking that line?
So I think acknowledging the reality, as you just pointed out, around, if you've raised money and you've got investment directors, you have a duty to deliver, try and deliver, do your best to deliver. And then second, I think is really useful is to start using language as a chair and helping investment director around, okay, you're wearing two hats, Ollie. Okay, you're Frog investment director representing Frog, and you're also Mike Reid, who's the director of the firm. So which one's talking at the moment? Your director hat or you? So kind of introducing language to clarify and de-emotionalize. And then, of course, the reality of tensions typically coming through underperformance. And of course, that's part of the frustration around acknowledgement sometimes, so continued underperformance, rising frustration and belief and rising frustration because my frustration with the underperformance is not being acknowledged. And so there, yes, so chair and the CEO, of course, and the full has a role in acknowledgement around, okay, Mike, I can see you're getting increasingly frustrated. Trust me, number one, what are you worried about? Listening that out and then acknowledging, right, rest assured, we are concerned as much as you are, if not more, about all these things. And then let me, at the next meeting, have the CEO really present, point by point, what we're doing about those issues that you raised. And if that's in your mind not good enough, let's talk about additional activities that we could be doing. So shifting it from sort of acknowledgement to clarity of the plan, and then debate on how can the plan change and getting back that alignment. So chairs have an absolutely critical role in that. Some of them put incredible amounts of time in to really keep that alignment because it's pretty fundamental. And of course, without it, sometimes it can destroy value and be incredibly stressful.
Like I can imagine lots of CEOs listening to this thinking, why have I not got an investor director like Mike on my board? Why have I got these idiots who are causing me hell the whole time? I want to move on to that third leg around the challenge support spectrum. And I think this is a spectrum common to all boards, not just scale-up boards, that it's so easy for board members to get tied into that challenge piece. It's been one of the biggest challenges for me of moving from being an investor to an operator, where I sort of almost feel like I've moved from being the book critic to trying to be the author. How do you think about that spectrum for chairs of scale-ups, and where do people tend to go wrong?
So I think that this is a really interesting one, linking to the final theme in the framework around the chair's role is partly to be providing their input and critique or support constructive feedback around the business and all the kind of in a strategic way, as we talked around. But actually, their more important role over the kind of midterm is to be the facilitator, motivator, and orchestrate the group, ideally a group that has cognitive diversity, and facilitate that group to great effect for the chair, for the CEO. So you want the CEO thinking, okay, in 3 years' time, wow, I've not only got fantastic, Ollie's just been great. He's always there for me on that sort of Friday call when I had that, he's a great individual and his input is good. But actually, that wasn't his biggest value. The biggest value was he had a vision that I helped him with around who was around the board table. And the group that we've got around the board table now, he finessed the investment director overbalance that we had. He's helped bring in more industry experts, and he chairs the meeting in a way that I get fantastic value out of those. That's ultimately the CEO where you want to get to, thinking, wow, I wasn't even expecting that dynamic. So I think that development strategy on the table of the chairs is really important, because it's clearly, as we map out in the framework, not just about how does the chair oversee the improvement of the CEO and the management team, but actually how does it orchestrate improvement in the board discussion and debate.
Really interesting. It strikes me that that's one of the most common problems scale up organizations find themselves in on that board side is where, especially when they've taken on multiple investors and every investor wants their director on the board, they then don't have any sort of independence, and everyone has their sort of the politics of their particular fund that they are bringing to that table. And so you end up with this highly dysfunctional group with too many people around the table, failing the sort of two pizza rule, and without anybody or without enough people who've actually operated a business, and really, as you say, really smart people who are really good at pattern recognition and really good with numbers, but not necessarily an appreciation for, what the CEO is going through. How do you think about developing that board and that mix of the independents versus the investor directors?
Yes, I think actually before going there, there's a load of things to do in terms of, if I can say, tactically, of chairing the business, not just the board. And so what I mean by that is, yes, you're right, through the scale-up phase, board meetings can balloon with board members, investor directors, investor observers, strategic investors who want to observe as well. And so there's only so much you can do to fight that. And so what we would encourage is sort of sometimes there's a really effective shift, few tools in the toolkit here. One is maybe moving some of the formal board meetings to a quarterly rhythm where they become actually more reporting tools. So less debate. The expectation is very much, and therefore having kind of closer director-only board meetings in between, or not even formal board meetings at all, just meetings. And then the other tactic is also, you can find some investors have a real need for a lot of detail around the financial performance of the business and really getting into details which can absorb too much time in the board meeting. And then, okay, let's strip out a CFO quarterly financial update, which is a great thing for getting the CFO to step up, et cetera, et cetera. And then, of course, finally, just thinking, right, actually, this is all just about human beings. So spending more social time together, having regular board dinners or whatever else, but in a sort of semi-chaired fashion. So, this meeting would just shoot the breeze and having a good time together to kind of just make sure we get to know each other. And other ones who say, right, okay, folks, we don't have to conclude anything over dinner, but I really want to hear your views on subject X, subject Y in a far kind of more informal, smaller group environment. So in short, I think there are tactics around how you get the best out of a group with hopefully cognitive diversity, as well as thinking longer term, like actually who is on the board, which of course sometimes is a bit trickier, and then deciding kind of what roles are there, which of course plays a hand. And then when you bring those people on, ensuring you have the tactics to actually get your money's worth out of them, because they're joining because they want to contribute. And if you've only got kind of quarterly board meetings that are too long and too reporting like, everyone's going to get a bit pissed off.
Definitely. I think it goes back to a thing you touched on earlier as well, where I think far too few scale-up boards have time built into their annual agenda for development and the review process and figuring out, is this working? Is this providing? I think it was William Reeve who once said to me, the board should be your highest return on time invested for any given period as an executive. And are we as a board meeting that threshold? And if not, why not? And how do we close that gap? And getting an external facilitator again often can help you hold that mirror up in a way that it's too easy to just assume you're getting it right. Do you, as a sort of standard course, have a board assessment process in place for every board?
Yeah. So the honest answer would be no. I don't really have a good enough answer for why. I think it's quite difficult to sort of introduce that. It comes across surprisingly heavy-handed. Oh gosh, bloody frog guys! They want a board review. I mean, what's the agenda? What are they after? So it's almost quite difficult to have something more formal. And I'm probably
funnily enough, there's another side to that coin, and this actually was going around one of the CEO scale up chats I'm in, where the founder saw it as a really good thing because the investors brought it in and said, we want to know how we can be better as investor board members. We want to bring this, and this is your opportunity to feedback. And it's very difficult for you as a CEO to talk to the capital and say you're doing a rubbish job. Whereas if you can do it in an anonymized fashion, hopefully you're not doing a rubbish job across the board, but it's much easier then to say. I love
the ambition, and I do love my experience is it just, worst case, you get someone saying, tell me what you think, folks, how am I doing? And everybody says, yeah, you're doing fine, because they don't want to. And then you've almost doubled up the problem. there's all sorts of, I'm certainly not against feedback and reviews. And I think ultimately the industry should get to a point where particularly chairs and non-execs start to say, well, I'm only here for this period of time. Interestingly, it's happening in the fintech scene more because, as regulated businesses, they can only be on the board for a certain period of time. It's actually quite a long period of time. But I think whilst we also try and tussle with that one, I think also, things like this framework, we've got a set of questions to ask yourself in the framework, which I think is useful to one I like is, okay, so how do you think your CEO would describe your chairing style? So, okay, there's no binary answer to that, but ultimately you're going, okay, what is my chairing style? And even just through the process, because the way we built this up was we spent a lot of time with all of our chairs to understand their thoughts, and then we drafted up the framework, and then we got their thoughts on the framework. So it was really interesting to see all of them kind of in a way lifting their game through the process, because they just were spending more time thinking, actually, why do I do that? Why don't I do that, etc. So I think a lot of it can be improved by just self-reflection and smart, interesting questions.
Really interesting. Actually, that recently one of the team asked if they could be chief of staff. My initial reaction was, what on earth does chief of staff do? And actually one of those had enormous benefits across a number of different ways, but one of them was just forcing me to reflect. Have since read various things around how do CEOs spend their time, and suddenly realized I was way off on various areas in how I was allocating my time. CEO excellence, what do the highest performing CEOs have in common? Again, a bunch of things that I wasn't doing. Yeah. Just having that, it's the same as, if you go to the gym on your own, it's a very different thing from if you've got a coach who's helping you through it. So that resonates a lot in a slightly different way. I want to touch on that last element to your 5-piece framework around the approach, that sort of adaptive versus intentional spectrum. And in my experience, both as an investor and board member and operator, actually, I've seen quite a broad spectrum. And I've seen some chairs who come with their way of doing things and are probably a little bit too rigid. And at the other end of the spectrum, you've got those who are really good at catching waves, aren't adding any value. They're good at picking the right horses to back. And you think, well, what's your value add? Where do you think chairs should sit on that spectrum?
Yeah, I think it's a really interesting debate. We are probing contention by saying that we think there should be much more intentionality about how chairs are thinking. Our conclusion really is that most chairs actually are more intentional than they think they are. Even the ones who start the conversation by saying, No, I'm totally adaptive, Mike. I really like to kind of get to the feel of the business, all that kind of stuff. After a series of conversations, you find they're saying things like, actually, funnily enough, I do that all the time, and I have a very clear view on that. So even though they don't articulate it, they actually do have a pretty intentional approach. They know pretty clearly what good and not so good looks like from their perspective. So I think that is really useful to get clarity on that. And some of those have, particularly in scale up, some have some really clear dynamic, they literally say, this is my model. Our experience is that those are very effective. So in the scale up phase, they tend to be less of the sort of governance. This is my governance framework as a chair, but much more of, okay, this is what I've learned from being a CEO and being a chair of multiple companies now. So the intentional framework stuff, I think, is what we're encouraging. And I think as a CEO who's looking for a chair, therefore should be expecting clarity on what their approach is. And if they're not hearing that, then they should be assuming, well, it is there. I haven't got to it yet. And therefore better questioning, more referencing if you're serious about hiring someone like that, because they will have, they might not call it a playbook, they might not call it a framework, but they will have a set of values, a set of expectations. You want to kind of establish what they are. One may be an obvious one around, okay, what is your engagement style? You're a weekly kind of catch-up person, you're going to be useful. Is that the kind of chemistry you're looking for? And you're getting references from other people that person's chaired that actually works really well? Or are you getting feedback elsewhere that's haphazard or not adding value?
I was reading a piece recently around how the brain starts degrading I think it starts, or whatever it is, from the age of 40, the cell walls start thinning and you basically literally losing physical mass in your brain at 0.1% a year. It starts dropping once you hit 60 at 1% a year. And
that's not, the good news is that that's not true, by the way. So
starts, okay. Right. So this is the argument. I mean, I assume that our brains do deteriorate in terms of the physical capacity at some level. And at the same time, and at least I would observe that as people get older, they become less flexible in their thinking, and it occurs at different ages for different people, and it's not uniform. But obviously there's a trade-off there of their experience. Is that something that you see? Do you think about? I mean, I've seen some chairs, as I say, who just come in with, they've got one size fits all, and they just try to apply that to every, to the person with a hammer. Every problem looks like a nail type approach. And then at the other end of the spectrum, you've got people who've never seen it before, where they're being forced to be very creative with their approaches. How do you see that playing out? Do you see there being an optimum time to catch a chair in their life cycle, or do you actually, just get different things from people at different stages in that journey?
So I think maybe the scale-up phase, particularly software companies, I don't see any of that really. I think it's almost self-selective of the type of people who've been in the industry and are sort of cycling back into wanting to be plural careers and do chair. They're just dynamic, interested, curious people. And I don't see any of the sort of set in your ways, aging piece. Actually see the sort of youthful enthusiasm, passion, creativity. So I see it's more of a sort of personality type rather than age-related piece.
Interesting.
That's my argument, and I'm sticking to it.
I'm going to dig out research.
We'll talk in 10 years' time when I'm definitely in that category.
I'm going to dig out that research for you. Although there are various pieces, funny enough, in Sweden where they track this, they've actually shown that first of all, the IQ of directors on average is higher, but that it does also degrade over time. Sort of mental faculties start to slow down. So I'd be interested to see your research on the other side.
We're definitely going off piece here. Yeah.
Mike, the time has flown by, and I think there's so much more we could explore, but it's time to go into our 5-question quickfire, if you're ready, where I'm going to say a short statement and ask you for a quick response.
Sure.
So first up, best book every board member should read and why?
Going for 2, Belonging by Owen Eastwood. Fascinating book about where you are in the journey with whatever you're doing, but a really fascinating and super impactful business around purpose and what it's all about, the big picture. And then reading Rebel Ideas by Matthew Syed.
Brilliant. Owen was a past guest. I don't know if you knew that. Did a piece with him.
I need an intro. I want an intro.
Favorite quote and why?
There are only 2 people important in your life: your 8-year-old self and your 80-year-old self.
Love it. Your best ever holiday and why?
Norway. Norway's twice what New Zealand is. Nothing against New Zealand, but it is absolutely amazing. Wonderful people, amazing place, expensive as hell, but absolutely fantastic.
Fantastic. Your most significant professional insight?
Alluded to it in the discussion, really. Big theme around the Matthew Syed book, actually. So cognitive diversity. I think we talk a lot about diversity at the moment, particularly male-female, which is we've got a long way to go on, of course. But actually, also, I think at the heart below that is, as a professional insight, if you as an individual can excel at bringing together and be a great facilitator, motivator of groups of bright people with strong cognitive diversity, you're special.
Your favorite podcast?
Aside from this one, of course, and Frog's How to Scale. Yeah, there's a great podcast by Dr. Ranjan Chatterjee called Feel Better, Live More, which is just brilliant.
Love it. Mike, thank you so much for taking the time today. It's been an absolute privilege. I feel like I've learned lots and wish we had even longer to go on, and we'll have to get you back on soon.
Really enjoyed it, Ollie. Great. Thanks very much.